Hey everyone, thank you again for joining me. This is part 3 of The Truth About Permanent Life Insurance, and I am again joined by Jeff Bernstein, who is owner and managing partner from Seligman Insurance. In this episode, I sit down with Jeff and I pick his brain on how can we go ahead and use these policies later in life. As always, Jeff is incredibly thorough, very thoughtful, capturing all the pros and cons, and I think he does a really good job separating some of the more practical points from some of the noise that you may be hearing. So we talk about, again, the death benefit, a quick summary on that. We'll talk about the corporate insurance retirement plan. And Jeff's summary on this is the best that I've heard. Very balanced, talking about all the pros and cons and key considerations. We will talk about infinite banking, and stay tuned to the end of the episode. I have a story on this. And then finally, we'll talk about the IFA, the immediate financing arrangement. And with that, here's my interview with Jeff Bernstein. Let's get into now, I think another really exciting part of this, but how can these policies be used? We talked about the death benefit. So I just want to clear up. So essentially the death benefit, will all of that, like every penny of that, move over to the next generation completely tax-free, or are there any exceptions?
Okay. So, when you're thinking about the traditional attributes of life insurance, as in a death benefit payment, this is thankfully very straightforward. Individually owned policies, I, Jeff Bernstein, buy my policy, not using my corporation, 100% of the ultimate death benefit or insurance amount will go tax-free to whomever I chose as my beneficiary or multiple beneficiaries in whatever allocation I decided. There are planning methods that, we're not talking about wills and trusts, but there are planning methods that, might call for more control and direction over those payments. Mm-hmm. You can integrate that planning with, wills and trusts, but quite simply, like for your listeners, the named beneficiary will receive the funds. In a corporate setting, so we talked about CDA earlier. So corporate owned policies will have a named corporate beneficiary, either itself, like a holding company, or a related entity. The corporate beneficiary will receive the insurance proceeds. The act of receipt is considered tax-free. $1 million policy, $1 million is received by corporation tax-free. The tax-free versus taxable portion of the distribution of death benefit payment is going to depend on that ACB of the policy that we discussed at the time of death.
This is interesting. What are your thoughts on permanent life insurance policies on our kids as a way to maybe do a good deed for future generations? Somebody had mentioned this and it crossed my mind. I was just like, wow, I know people out there who are in fact putting in maybe a few $100s a month for each kid, but then these things are going to grow over time and be passed on to, I guess, our grandkids. What's your take on that? When is this a good action?
I didn't even think about it from the standpoint of preparing notes around this, but just say, like, if anyone is lucky enough to have grandparents, like your parents that like your kids more than they like you, as would be the case in my family. Like if you can get them to do this for you instead of allocating your own cash flow, like that's a great option. But I think as a comment, like this ultimately comes down to choice and allocations for your money. Obviously, we're talking to a more affluent listener base, but if you're fortunate to be in that surplus position where you've maintained maybe good debts but are otherwise debt free, you've maxed out registered and sheltered accounts, RESPs, TFSAs, RSPs, you're sufficiently insured, like you yourself have the necessary ingredients, not permanent insurance necessarily, but where there are no income replacement gaps to your own life. And by the way, insurance companies ask that when you're submitting a policy application on your child. They ask, how much does the parent have? So allocating some of your discretionary dollars to these policies is fine. Just like a few other things, I know it can be icky to think about this, like when you think actually about like, oh, it's my kid who has to pass to get the money. Some cultures like even have stigmas around doing this, but there is value in giving your children a baseline level of insurability through one or more policies that may be acquired later on in life as an unappreciated gift or underappreciated gift. And I would say, especially as medical trends move towards more data and more advanced and early knowledge of our potential pathologies in life, these might have downstream implications for insurance underwriting at a time when our kids are raising their own families potentially and thinking about their insurance needs. the other thing here on which is neat is that, for affluent families, there's something to be said for the accumulation, the control, and the tax-free transfer of wealth that these policies allow. Whether that's on death of the individual, so death benefit was received, or in the case of maybe a grandparent who names a joint or successor owner, so name the adult kid for the insurance, and that allows the growth to compound over decades. These transfers would otherwise be taxable if the investments were held outside of a life policy. And just for full disclosure, like I have very modest permanent policies on each of my 3 children. I'm not pretending like these are going to be policies that they'll be able to borrow significant sums of money from one day to fund their education, start a business, buy a home. These are often like the things, or pay for their wedding or whatever it is. But for very little money annually, relatively on their lives, these are going to be great to pass along to them in 30 or 40 years from now, assuming that, they're responsible adults. And I feel like they're not going to just cash out the policy, but that's the risk that, that you face, right?
Yeah. Okay. So that's interesting to know that you are taking that approach. Now, okay, this is a big one. This is really interesting. The corporate insurance retirement plan. So the mechanism that I have been kind of explained is that you have a corporately owned permanent life insurance policy that's going to kind of grow over time. You've got the death benefit, you got the cash value. And then basically later on in life in your retirement, you borrow from the cash value. My understanding is kind of up to 90%. But how you do that is you can use that policy as collateral for a loan. Either it goes directly through the insurance company or you go to like a big 6 bank and then Bob's your uncle. Everything's great. So that's how I've been explained this. But then I've also heard of people who called up a big 6 bank, explained this concept to them, and then the bank branch basically said, like, we've never even heard of this. I was just like, okay, that is troubling to me. I know some people who have told me that, yeah, this is my retirement plan. I'm just going to pull money out from the corp, tax-free, and then the death benefit can pay off the residual on the loan later. Everything's gravy. And to me, I'm just like, well, it seems like a bit of a loophole. That's maybe too good to be true. What if it's axed? Then what happens to that plan? This is a heavy question, Jeff. I really want to know, what are your thoughts on this? Is it viable? What are the pros and cons?
You just buy the policy and you borrow the money, right? It's that simple. Just take the money. Yeah, and it's there. It's your money. I'm like the worst at sales because I end up like stopping more sales of these plans because, again, like I just focus in on, not the negatives, but on like, just educating clients, prospective clients, whatever it is, about these myths. So, okay, a lot of comments to be made. I'm going to go in the order that I put them. So the potential for accessing cash values while someone is alive is really important. It's important to know that as a security blanket that, I'm not just sending tens of thousands, hundreds of thousands of dollars down the line that I can never, ever again touch. More often than not, with our client base, which includes lots of physicians, lots of other incorporated professionals, real estate investors, business owners, high net worth people, we find that it's actually the allure of access rather than necessarily doing the access that is the most important thing for our clients. They like knowing that their cash is still in their proverbial pocket. They don't necessarily need to touch it to be comforted by this fact. And these are, for us, the best owners of permanent life insurance because they get it. They aren't buying a scheme or a program or something that was marketed to them as this thing that they have to do and that, the insurance policy must be used in their lifetime. People forget that most borrowing arrangements ultimately hinge on a death benefit being used to repay a loan. This is still the primary value of insurance. You're buying it for the death benefit. Insurance companies, they love selling this stuff, but they ask, they want to, make sure and underwrite that there is an insurable, need, interest, want, whatever it is. But this is why it's important, as I spoke about earlier, just to maximize those IRRs to as late in one's, lifetime, 90s, as possible. Because ultimately, if someone does go ahead with doing this, unless they plan on repaying the loan with other sources of funds in their lifetime, the insurance policy has to grow. It has to be significant enough. So in general, and I'll speak about this specifically, but no one's going to reference this. Cash value can provide none, some, or all of the collateral required for a bank loan. Generally, when we're talking about collateral loans, Yatin, whether it's the big six or it's alternative lenders, like there are way more alternative lenders in this space, like primary lenders, not private mortgagers or whatever, like your uncle in the garage or something, like right. But yes, I mean, sometimes like the big six, they it depends where you are, right? Like it depends if you're doing private wealth banking. It depends on, your net worth, all sorts of other things. But you asked, and this is really important. So this is about, where did this idea come from? Like, is this prescribed in legislation? Is this, just me on the street telling you buy this thing because here's what you can do? I designed this, this loophole, this scheme. So the Income Tax Act, very specifically in subsection 148.9, paragraph F, specifically excludes a collateral assignment of a life insurance policy from their definition of disposition. This is important because doing so avoids a policy gain. This is how you theoretically can take your policy as collateral for the cash value, take that loan, but also allow that cash value to continue accumulating on a tax deferred basis. And of course, like within bank limits, allowing, different sources of loans, and potentially subsequent loans, like more, right? But a collateral assignment also doesn't change the policy's ability to produce those tax-free proceeds on death. But, when we get into sort of more of the mechanisms, there are some steps that are required to ensure that loan obligations are satisfied in certain ways when shareholders might be considering borrowing using their corporate policy as collateral. This is like the thing that everyone wants to do.
This is my thing. So this is a corporately held insurance policy. So it's accruing in the corporation, yet I'm using the cash value as a collateral for a loan that's going to come to me personally, or at least this is how I've been explained it. Like, is this legit? Like that's to me where this seems kind of sketchy, if I can be honest. But I just want to know if it is legitimate.
Is it legit? 100%. Is it advised? It depends, right? I mean, when I say advised, I don't mean like, what's my opinion of this? Ultimately, like we advisors like to, we pay for this in ways that are sometimes, again, bad for our, our sales or our bank accounts. But, ultimately it's a client and their accountant, their key tax advisors who are going to be in the position to make decisions about, what comfort with tax risk they're willing to do. So, if we go by the book and we just say, here's what's happening. It's there. It's in the act. It's allowed. People do this all the time. Like this isn't egregious. This isn't, Wild West behavior. Like this is probably, just the tipping point of like what, more adventurous strategies kind of entail. Like this is pretty standard fare. Doesn't mean it's a good idea or what are the steps that one would have to take to make sure that this, stays within the lines. That's different. Could they look at this in the future? Like with anything, right? I mean, this is a government. I don't mean like the current government. I mean, in general, our government needs tax reserves, tax funds to pay for things that we are consuming or that they like to think that are for us, right? So are they going to come after these schemes, these shelters, whatever you want to call them, at some point in the future? We don't know, right? But I think the point that's important to make, and I've had accountants who have referred clients who have they've come in and they've said, we have excess funds in our corporation. We want to build them up in a tax sheltered environment. We know about life insurance. Just give us the life insurance. Here's what we're going to do. So I will always tell someone that, retirement strategy, specifically, insured retirement programs, whether corporate or personal. But, the idea behind retirement strategies are that, they're back end leveraged. Like I would say as a general rule, back end is going to be, a safer, like more comfortable approach than, immediate, which we're going to go to. But retirement strategy projections using life insurance are insanely variable, and they make significant assumptions about the future. So, examples, the future insurance values, death benefit values, cash values, when someone is planning on starting their borrowing, when they are planning on stopping their borrowing, how much income they are targeting from their plan, whether this is going to be corporate borrowing. So, corporation go, like you're a business owner, or, you have an MPC, whatever, you borrow that, you want the funds to invest inside your corporation, that's fine. Or shareholder borrowing. So me, the individual who controls my company now, is using a corporate asset to give me personal tax-free income. The guarantee fee that someone has to pay for that privilege absolutely has to make sure that this isn't considered shareholder benefit. And borrowing rates, right? So I have said to people, if you have a long-term vision of this, a long-term horizon, you're in this for many years, not 2 years, not 5 years, and you can sock away a bit of money in this. And there's a potential that you might want to look at this option down the road. It's not necessary to your lifestyle, but it might be supplementary. It might be, there's an opportunity that comes along, you want to explore it. Of course, that option is there. You can do it. Should this be the primary reason that a permanent policy is sold? No. I don't think that is the best way of approaching it. And the other thing, and I know we're going to talk about this, I don't necessarily want to get into, a fight between me and the infinite bankers, but
oh yeah, it's coming. It's coming.
I know. But, third-party lenders, whether Big Six or others, generally they have a minimum borrowing threshold for these policies. At a very minimum, we're talking about $50,000. That's not in the league of who does this and how much money is being socked away in this, that's not considered a lot of money. So if you are, smaller time, you're putting aside money that, again, maybe you can't afford to park in this vehicle, and it really is going to be, a significant source of your retirement wealth. I would just caution and say that, again, this is for affluent people. And the irony of it is that the best people are the ones who don't actually need it, right? This is a life insurance is an instrument that was designed to benefit widows and orphans. That's why we feel really good that the government isn't coming to remove the death benefit, feature, the tax-free payment of death benefit. They can't touch that. But, when rich people who, the public doesn't necessarily have a whole lot of sympathy for, starts going to town with these things, that invites a little more scrutiny. So, that's sort of the point that I would just say, is that know your audience.
Perfect. Jeff, I think that's very, very well said. So if somebody decides to go this route, use the cash value as collateral for a personal loan, and let's say they pass away, they don't pay that back, then I guess it's the death benefit that would be paying off that loan that was taken, correct?
Has to be. And that's why, again, when we talked earlier about optimizing for different outcomes, you can't forget that the estate or the death benefit needs to be paid. It needs to get into the hands of somebody, so that either the loan is wiped out or the estate is going to have, the best possible outcome from here. It doesn't mean that, again, these aren't advantages that one can have and just know in the background that they're there to support their investment decision. You should be able to have your money in your lifetime, but it's not as simple as everyone promotes it to be.
Okay, you mentioned infinite banking. I think you knew it was coming. So I attended a seminar that was on permanent life insurance, and it was about half an hour long, and I couldn't believe that 20 minutes of the 30 minutes was on infinite banking. I was just is this really what this is about? So I was in total shock. And then I got a phone call saying do you want to participate in this for infinite banking? And I said no. First of all, I didn't really understand it at the time, but I've dug into it a bit deeper. Just shed light on this concept of infinite banking, being your own banker, and maybe there are pros, but talk about some of the cons and limitations of this as well, I guess.
Okay, so we'll go to IFAs and things like that after.
Yeah,
but
that's the next
I had a call from a client who was, again, they saw a video on TikTok, right? this is where they heard this. And my hunch would be that it was the American version of, our audience of TikTok, where, again, the rules are different over there. The rules in Canada are clear. The one thing that I'll say that I agree with on infinite bankers or their way of kind of looking at life insurance, even though they don't market it this way, and my comments are going to touch on this later on, but there are some points of similarity or agreement where I think, in my mind, when you're looking at a possible investment acquisition that is tough to get out of, at least if you want an optimal outcome, it's important to have, as many off ramps, as many like good options for that owner as possible. And in general, the way that, infinite bankers think about life insurance, it's not about death benefit, right? It's about, how much money are we accruing in this vehicle that we are going to be able to borrow for day-to-day uses, for big uses. I don't know. It's crazy to me, but it's not life insurance for life insurance. It's life insurance for cash accumulation. And often it's to people who don't have corporations where there are huge tax advantages of using life insurance. It's for people who have no business being in this, because, I think when we were emailing, I just said, like, I don't think that this belongs at a retail level. Like, I think that there's absolutely a mass market use for permanent life insurance. You want to guarantee, your burial, your, income to your kids, your spouse, whatever it is, like the boring, pedestrian, plain vanilla uses of life insurance. Fine. Knock yourself off. Buy $100,000 of non-par life insurance. I don't care what you do. Like, that's fine. Take care of your family the way that you need to sleep at night. But, the whole premise of infinite banking is, buy not just one policy, but a series of policies, and, build this habit, this learned exercise where you're growing your values, and you are the banker, and you don't need those suckers who who are trying to charge like usurious levels of interest on money that's yours, right? Like, my money's sitting in my checking account at TD. Like, fuck them. Like, why are they charging me all this money to pay a bill? Like, this is insane, right? Like, why am I paying account fees? Whatever. Like, all of this stuff. I'm sure I'm not doing this justice, but the problem here is that, and we didn't talk about this, but and I didn't really prepare for too much discussion around it, but policy loans, which are more typical of infinite banking propositions, these are the contrast to the collateral loan, where you go to the insurance company and you say, "This is my money," and they will give you that money. And they will give you up to, certain limits of it. And up to certain limits will be tax-free. But beyond those limits, the money that's yours, that's been growing in here, tax-sheltered, can become taxable.
Wow. Okay. I didn't know that.
That is usually the approach that infinite bankers are promoting, because it's more direct. It's certainly more, it's quicker. Like, you don't need to now furnish all sorts of, income statements, typical loan requirement. If you've ever qualified for a mortgage as a physician who hasn't incorporated necessarily and is coming out of residency, whatever, like, the hell that you have to go through, as a sole proprietor sometimes to justify like future earnings, various things, right? So, the idea here is we don't want to make this complicated. It's the insurance company that has your money, and you can go and ask for it anytime, and just go and buy that dishwasher with, the money that you took out of your insurance policy, and repay the loan, when you've got the money. Like, I mean, to me, this is it's insane, but I don't know. I'm listening to those podcasts just to try and get an idea of like, what they're doing, how they're speaking about things. Like, there's obviously something that is really appealing to, a vast segment of the population that is considering this, or at least consuming, this media. And like, hey, just from like a marketing standpoint, like, shit, I wish I had a lick of their skill, but I can't. It's just like, it's gross.
So you just said that if you go and borrow some money above a certain threshold, it can become taxable income.
Yeah, up to the ACB. So, we were talking about ACB in the context of corporations generally, but this, and because like, for most, again, for, average person affluent people, business owners, physicians, like they're generally not going to find themselves in a position where they want or need to ask the insurance company for a loan. So, generally speaking, like ACB figure doesn't really matter until someone actually passes away. But, if you are that individual in the street who's maybe bought a small policy and you've got, I don't know, $5,000 that's sitting in there, and you've got a bit of a cash crunch and like you want to access it. So that's when ACB really matters, because you can borrow up to that level tax free. It's a policy loan and you're going to have to repay it. It's not like you can just let it, capitalize and never repay. Okay. Otherwise your policy is going to the shitter. But above that amount, that's taxable income. And we're going to talk about this, but it's taxable as like it's full taxable income. It's not a gain, right? Wow.
Okay. And when you borrow from, I guess, the cash value component of the policy, I guess you're paying interest, right, on that as well, are you not? And that interest is going to either the insurance company or the bank, is it not?
It's going to the insurance company. So like I think the philosophy around this, and this is where like it's a little bit weird, right? Because I mentioned this earlier that policy loan rates are one of the ways that the par fund is going to actually make money and redistribute that collectively. We don't know how, but redistribute it to policyholders. So if you're thinking about this from an ownership standpoint, like I own this par policy, so I own this insurance company, this mini insurance company. I want a high loan rate because I'm making money. But if I'm the borrower, I don't want to pay 8%. I don't want to pay 9%, 7%. Right. Like that sucks, right? I want to pay, banker's acceptance or maybe prime, whatever. So yeah, you're paying that money, but I guess the idea is like, well, you're paying it back and it's recycling back into your hands one way or another. So that's where the recapture is happening maybe, but
Yeah. You know what? My understanding of this is, let's say you're borrowing from the cash value. Okay, you pay some interest there to borrow that money, but because there are dividends flowing back into the policy, you're at least recapturing some of that. But I think a few people out there who are critical of this approach, my understanding is that because the par fund, the dividends, and that whole black box that we talked about, we don't have a full grasp of it. It's really hard to put that much faith into the infinite banking concept. And I have to agree with them that because what's the difference? Like, let's say once interest rates fall, what if I take the HELOC on my home and what if I use that to basically, invest in a bunch of the big 6 banks or something that are going to be paying me a dividend of like 5+%? Like, how is that any different? I guess you could have a drop in the stock price, but over the long term, it goes up, and at least I have clarity on that dividend. You know what I mean? So that's why I think infinite banking is a bit flawed.
Yeah, and like on that example, I mean that's a great example. Like most people, I mean, the best time to ask for credit is when you don't need it, right? You never want to go cap in hand to your lender and say like, give me money because I'm in a pinch. So if you have a HELOC set up that you're not using, that's just a source of future whatever. Like maybe I want to make a renovation, I want to buy something, I want to go on a trip, the cash isn't available, it's bridging a gap. I think the more buckets that we have that we control, that's a good thing. But focusing on it as a program where you're marketing this concept that I'm now in this like loop of I have to do this thing and I have to like commit to the stay the course, and it's all going into this thing. And like, I'm going to now be moving away from traditional, lending instruments or traditional sources of financing. Like, I don't like that. Like that's worrisome to me. I think if you do this and you set it up in the right way, you're going to have those reserves in there. You're going to have the cash value. Like you can call it infinite banking or you can just call it life insurance. I don't really care what you call it. Like they have to call it infinite banking because life insurance is a detestable term. Like you don't have to like life insurance to like what it does for you, right? We know that. And like, my LinkedIn headline, whatever, all that stuff is about that. But again, like you can do that. You can set it up. And if you really need to lean on it, great. But whoa, like parking all your dollars here? No, like that's no.
Do you want to take a minute then to just talk about the immediate financing arrangement, the IFA? Because that's a term I hear about a lot too, and I don't think there's enough clarity around it.
Yeah. Like, I mean, we have some clients that are on IFAs. We have clients that have not actually gone through with IFAs. They've taken the policy, they've set it up with the intent, they never did it in the end. Like, we've seen this, but in general, the number of times that the concept is pitched in the market, I think even like insurers would admit that who actually goes through with this in the end. Like, I mean, maybe it's like 1 in 100. But I'll give you the pitch and then I'll sort of tell you the strategy. So the basic pitch, using really round numbers. I know these are insane numbers, but this is not uncommon. You got some money lying around, in your corporation. Make a single premium deposit into a life insurance policy of $1 million or $100,000 or whatever scale number you want to do it at. Your initial life insurance amount, again, I'm sort of just using round numbers, is $5 million. The cash surrender value, the way it's set up in the first year, is $950. So it's close to your deposit, but it's not, the entire amount. You now go to a lender, maybe it's your bank, maybe it's an alternative, whatever, and you ask them to borrow $1 million. You're going to need to put up some additional collateral, most likely. There's certain lenders that will skip some of these requirements. Depends on your net worth, all sorts of requirements. But if you die in the very first year of that policy, which sucks, obviously, your family will receive a $4 million death benefit. That's the $5 million life insurance payout minus the $1 million repayment of the loan. If you don't die, the growth in cash value allows additional future loans to be made with interest capitalized. So it is a revolving, I may have the money, but I'm not tying it up in this insurance policy. I'm taking that and I'm now going to reinvest it. I'm going to reinvest it in my business, investments, real estate, whatever it is, right? So immediate financing arrangement, the IFA concept. So, or sometimes you hear premium financing or free insurance. Better than like when you put free in front of something, right? But it's recognized. It's a financial planning strategy, for high net worth, affluent investors that uses the cash surrender value of a tax exempt permanent life insurance policy, and as we said, potentially additional assets from other sources as collateral to acquire a loan to fund premiums. The immediate in IFA, it implies that you have to do this right away. But the reality is that funding can happen as soon or within the first few years, or whenever you want, really, of purchasing the life insurance policy. It's more a question of timing, when the money is put back in your hands. And when premiums are paid and the cash value of the policy increases, revolving loans are taken from a qualified third-party lender. So the strategy itself depends on those borrowed funds being used to earn income from a business or from other income-producing investments, a portfolio of real estate, whatever, to create deductibility of the interest expenses against otherwise taxable income. The rate of return on the borrowed and invested funds, obviously, it's expected to exceed the after-tax rate of purchasing the permanent life insurance and borrowing against the cash value. An overhyped, but generally very small portion of the actual premiums, unless someone is like highly rated, may also qualify for a deduction. So it's a program that's based on many factors. High income, lots of deductions, a borrowing rate that's certainly not where it is today. But what I was going to say is that, ultimately, obviously, like on the death of the insured, that those life insurance proceeds are used to repay the loan, and any remainder is paid to the beneficiary of the life insurance policy. I think one of the factors that makes an IFA very interesting, more interesting than the other things that are promoted, is that there are some enormous surplus extraction opportunities for a business with significant taxable investments because of the massive CDA credit that can be created by the life insurance, which is typically going to be well above and beyond the loan repayment amount. This is almost like, again, with CDA, it was covered that, you might have a CDA balance and, you need funds to pay that out. If you have the funds, you can pay it out tax-free. The life insurance amount will generally be less than the CDA credit that was created. So if you have other assets, if we're in an environment where, there's a clampdown on strips and various, planning methods that high net worth people use, like, of course you have to die for this to have happened, but, your corporate beneficiaries, your shareholders that remain, they have, a great tool here at their disposal. I mean, this is stuff that life insurance would do anyway. And, combined with post-mortem planning that you probably talked about on other episodes. But that's where I think, to me, IFAs are neat. And those are usually like, they're monstrous. We're not talking about $100,000 policy. These are, they're big, right? But, the thing that's obvious here is that, like, the current borrowing environment has just dampened and put on ice so many of these conversations. They may have set these up and they may have, planned on putting significant money into it. But, when borrowing rates were what they are, like the spread risk between borrowing and insurance crediting always has to be looked at. We have charts of like historical risk or historical spread. This is obviously like a terrible time to be doing this. It doesn't mean that, you need to forego the insurance. Like, you can set up the insurance, and if this is a facility that you want to take advantage of in the future, you can always do that. And you can always reduce, premiums to the minimum required amount. So I'd say, while there are opportunities for IFAs to make sense, they are for the rarest of investors in permanent life insurance who are extremely comfortable with leverage. You have to have significant portfolios of real estate investments or growth-based operating businesses. And you need the insurance for estate purposes. Otherwise, and otherwise hate the opportunity cost of tying up your money, in insurance. So it's a really specific profile.
So a few months ago, I was having dinner in downtown Toronto with my very close friend, Patrick Oxiano from Vancouver, and we had a lot to catch up on that night. And one of the things that came up was personal finance. So interestingly, our waiter tuned in on the conversation and he decided to come and join us. And guys, I have no problem with this. I love to talk to people. I love to learn about where people came from. But what was interesting about this is one of the very first things that he mentioned was permanent life insurance and infinite banking using this approach. Now, I have to be honest, this I really didn't appreciate. There was a lot he could have brought up, but he decided to bring this up first. So I proceeded to stop eating, and we went back and forth for about 10 minutes on infinite banking. Now, what blew me away about this episode is infinite banking is literally everywhere. People are talking about this everywhere you go. So again, to Jeff's point, you want to be very careful about where you're learning about these concepts. Ideally, not at a restaurant, ideally not on TikTok. You want to make sure the resources you're using are reputable. So you guys can probably understand how we feel about infinite banking, but I want to throw it out there to the infinite bankers. Like, if I'm missing anything, if we are missing anything, you guys can reach out to me. I leave my contact information on all the show notes, beyondmdpodcast@gmail.com, and social media links for myself and Jeff Bernstein are in the show notes. Thank you again for taking the time out of your day to join us. We hope it was useful. And next episode, the final installment of The Truth About Permanent Life Insurance will drop tomorrow morning on Friday. Stay well and see you soon.